Every organisation, no matter how big or small, needs to move money in and out, paying suppliers, receiving money from customers, or handling regular expenses. So when we say payment methods, we simply mean the different options available for making or receiving those payments. Let's go through the main ones you'll come across in bookkeeping. The most traditional method, physical coins and notes. It's simple and instant, but not ideal for large transactions or detailed records. So, cash is often used for small or local purchases. A cheque is a written instruction to a bank, telling it to pay a specific amount to someone. Although it's not as common today, some traditional businesses still use cheques, especially for supplier payments. Debit card is an electronic payment taken directly from a bank account. It's quick, convenient, and ideal for everyday business transactions or purchases. Credit card is used to borrow the money from the bank and then repaying it later. It's great for managing short-term cash flow. For example, paying for travel or online subscriptions. Bank transfer means transferring funds electronically from one bank account to another, for example, paying a supplier invoice. Bank transfers are fast, reliable, and leave a clear record of each transaction. In the UK, bank transfers can move over different systems. The main ones are faster payments, usually instant, seconds to 2 hours, ideal for day-to-day transfers. BACS takes about 3 working days, great for payroll and bulk or regular payments at low cost. CHAPS are same day for high-value urgent payments. Fees apply, used for large urgent business transfers. Standing order is a fixed payment set up by the business. The same amount paid on a regular schedule, like rent or loan repayments. It's controlled by the payer and it continues until it's cancelled. Direct debit is controlled by the receiver. The receiver decides when to collect payments, which is perfect for variable amounts like utility bills or subscriptions. Online payments like PayPal and Stripe are online payment systems. These are digital platforms that make it easier for customers to pay instantly online. They're perfect for e-commerce and freelancers because they're quick, secure, and widely accepted worldwide. So, those are the main payment methods businesses use. Each one has its pros and cons, and the best choice depends on what's being paid for and how the business operates. Now that we've covered the types of payment methods, let's look at how to choose the right one. There's no one-size-fits-all solution. Businesses need to think about several factors before deciding which method to use. First, cost. Every payment method has a price. Bank transfers or card payments may include fees, while cash can cost time to manage and deposit. Next, speed. How quickly the money moves. Card and online payments are instant, but BACS bank transfers or cheques can take several days. Then, security. Some methods are safer than others. Electronic and direct debit payments are more secure than handling large amounts of cash. Record keeping is also key. Bank transfers and cards leave an automatic trail, which makes bookkeeping easier. Cash, however, requires manual tracking. Finally, suitability. Not every method fits every situation. A retail shop might prefer card payments because they're fast and convenient for customers, but a supplier might prefer a bank transfer because it's traceable and easy to reconcile. Now that we've seen how businesses record their payments, let's move on to one of the most important accuracy checks in bookkeeping, bank reconciliation. Bank reconciliation is simply the process of comparing the business's cash book, our internal record of bank transactions, with the bank statement provided by the bank. We do this to make sure both records show the same balance. Why is this necessary? Because timing differences and errors can easily occur. The bank may record something before or after we do, or we might have missed a transaction altogether. The main purposes are to spot timing differences or errors, to confirm the real balance available in the bank, and to detect fraud or missed entries before they become bigger issues. It's completely normal for the cash book and bank statement not to match exactly at first. There are many legitimate reasons for this, and understanding them helps you reconcile accurately. Common reasons include: first, outstanding checks. These are checks we've written and recorded, but the bank hasn't cleared them yet. Until the supplier cashes them, they don't appear on the bank statement. Second, deposits in transit. That's money we've received and recorded, but the bank hasn't processed it yet. Third, bank charges. The bank may deduct service fees automatically, and we only find out when the statement arrives. Fourth, standing orders or direct debits. They are automatic payments that the bank processes but haven't yet been entered in our cash book. Let's look at our full bank account reconciliation example to see how it works in practice. We start with the closing balance from the cash book, in this case, £3,000. We notice checks for £500 that haven't yet cleared, so we add them back. Then we subtract £50 for bank charges that the bank has recorded, but we haven't yet entered. £100 standing orders processed by the bank, but haven't yet been entered in our cash book. £1,000 deposits in transit we've received and recorded, but the bank hasn't processed it yet. Once those adjustments are made, both the cash book and the bank statement show the same adjusted balance, £2,350. That's the goal of reconciliation, to identify the differences, adjust for them, and end up with matching figures on both sides. The adjusted balances must always agree. If they don't, it means something is still missing or wrong. Here's the step-by-step method you'll use when preparing a bank reconciliation. Step 1. Compare the entries in the cash book and the bank statement line by line. Step 2. Tick off all the matching transactions. Step 3. Highlight anything that doesn't match or is missing. Step 4. Make adjustments in the cash book for any items not yet recorded, such as bank charges or direct debits. Step 5. Prepare the reconciliation statement showing how the cash book balance and the bank statement balance line up. And finally, Step 6. Make sure that after all adjustments, both balances agree. It's a very logical process. Once you practice a few times, you'll find it becomes second nature. Now, even though the process is straightforward, there are some common mistakes that can cause major confusion. For example, double entry mistakes, where a transaction is entered twice, or reversal errors, where debits and credits are swapped. Sometimes people record payments or receipts on the wrong date, which makes matching difficult. Other common issues include missing standing orders or using the wrong bank statement for the period you're reconciling. To avoid these, always cross-check your figures against the source documents, invoices, receipts, and statements. In reconciliation, accuracy matters. Small errors can ripple through the entire bookkeeping process. Finally, let's talk about why reconciliation is so valuable to a business. First, it helps detect fraud or unauthorized payments. You'll notice immediately if money has left the account unexpectedly. Second, it confirms the accuracy of your cash book. Third, it ensures the business always knows its true bank position, not just what's on paper. And finally, it builds confidence in your financial reporting. So, to summarize, bank reconciliation is not just an administrative task. It's a vital control that ensures trust, transparency, and accuracy in the accounting process.